For the time being, let's get stock specific then. And we have Siddhartha Khemka, the head retail research at Motilal Oswal Financial Services, who joins us on the show. Hi, Sid. Morning and good to see you, Ben. Top stock to focus on, TCS. The numbers look better than expected, both on the revenue as well as margins. On the flip side, though, some would argue that the TCV isn't as much as expected. But even though we go on saying that TCS is not particularly cheap, but the valuation gap between TCS and some of those tier 1 companies have actually narrowed. And that could call for a re-rating in their multiple even from here. Your view on the stock?
Yeah, very good morning, Nigel. Glad to be on the show early morning. So if you look at, yes, there are two parts to the earnings, clearly above expectations in terms of revenue growth, largely led by India. And again, in that particularly the BSNL project ramp up that has helped the company gain the kind of growth they have been able to show. In terms of deal wins, I would say that there is a high base. We had seen a very strong order inflows in some of the previous quarters, and because of which we are seeing a sequential dip. But I would say it is still within its usual range. So $8.3 billion of deal wins is within their usual range. Nothing I would to be worried about in that sense. Margins have been better than expectations. I think overall read through from the TCS results and the commentary comes out clearly very positive for the entire IT space. Things will take time to improve. There is definitely a slowdown, and you can say the spending environment is yet to revive, but things have stabilized. And from here on, I think FY25 will be a stable year, and FY26 will see the recovery. So for FY25, we are building in a 5.5% of constant currency revenue growth for TCS, which is a good, decent growth on FY24. And for FY26, we are building in a recovery and building in around 8% of growth. With the largest order book and the most diversified, long-dated projects, I think TCS is well suited to face the current slowdown that we are witnessing in the entire IT spending. And while the valuations, I think some of the other top tier IT have narrowed down, we believe that TCS premium valuation would continue. So we continue to value it at 30 times on a forward earnings and maintain its buy and as a preferred pick within the IT space with a target of 4,660.
4,660. That's still a fair amount of headroom from where we are. Siddhartha, hi, morning. What about the others? I mean, because they're saying that growth has returned to all markets, almost all verticals, I think the street will want to believe that this signals the end of the dark winter for the entire sector. Beyond TCS, would you load up on any of the other IT names? And just in terms of the portfolio construct, what percentage would you give to IT, and how much would that change based on what TCS has said now?
Yeah, definitely should be. So if you look at, as I said, the read-through from the TCS numbers and commentary makes us positive on the entire IT space. So from a portfolio construct perspective, we are now marginally overweight on IT compared to our underweight stance earlier. So some of the other IT companies that we like, so HCL Tech is our preferred pick. We believe that it's the portfolio is much more and relatively more resilient to the adverse macro environment. Its exposure to cloud, which compromises a higher share of the non-discretionary spending, offers a better resilience in its portfolio in the current context. And the overall growth as well as valuation is pretty comforting there. The other stock that we like is Infosys, again, among the larger peers. So these are the three stocks that we like: HCL Tech, TCS, and Infosys within the IT pack.
So that's what else? I mean, we've discussed technology. Let's talk about the market's Achilles heel as well. HDFC Bank. I mean, would you still retain a positive view? Or is it just best to look elsewhere within banking? I mean, from a more short to medium term horizon.
Yeah, so I think from a short-term perspective, one definitely needs to look way beyond HDFC Bank. They have come out with the quarterly updates. So the street was excited earlier after the shareholding pattern came in and with the expectation of some MSCI inflows. But the business continues to remain a bit sluggish, especially on the deposits front. For the first time, they have also come out with the average deposit growth rate, which is still better rather than the quarter end deposit numbers. But I would say there are banks which are doing comparatively better. So we like the public sector banks, especially SBI, which has been consistently doing well. And within the private space, ICICI and Axis would be our preferred picks for the short term.
Okay, thanks a lot for that, Siddharth.